Morning traders, welcome to the Flow Show. Here we are, it's Tuesday and we're all ready to rock and roll. Morning Kay, morning Stel.
Good morning, good morning, good morning.
Good morning.
How we doing, lads, all right?
Perfectamundo, yeah, thanks mate.
Oh, good.
Good.
How are you?
Yes, all good mate, all good. A little bit cloudy here this morning, but hopefully just a blip before we get the sun back again. How's it going with you, mate? You full on summer now?
Oh, 30 plus Celsius, yeah. We're good.
Very nice, very nice. Good to hear it. Right, well, let's get the show on the road, as we say. Going to start, as we often do, over in China, and some torpedoes sent out by officials overnight. They started by fixing the reference rate at the low end again, kept it under 7.21 by 2 pips. Expectations were for it to come in about 100 pips higher than where they set it. So that was act number one in keeping the fix low, or the low end of expectations. Then early this morning, China's state banks apparently were in selling dollars in the offshore currency market to prop up the yuan. That's that move you can see right in there. So the brakes are being applied, and much around the area that I expected them to start coming in. I said if we got up to the 720s, 725s, the risk will grow that they would start at least applying the brakes. We're yet to see if this is now a red light and they're not going to let it go any further, or whether they are just slowing down the moves and just giving an indication that they're watching and that they're ready to step in as and when needed. First thing I did upon seeing those headlines and seeing the price was get out a massive chunk of my longs, locking the stop higher up. So now I'm locked in from my entry well above, and keeping a little portion on just to see if it does manage to get back higher. The price actions are going to be key up here. If we start finding a bit of a top forming around this 725 area, and they keep acting and keeping the fixes down, that is an indication we might be at or close to a top, and then I'm going to be looking to get out. I don't think I'm quite ready to turn the other way yet, because, as I say, this might just be a first step in slowing things rather than reversing things. But it's a strong signal, and as we've been talking about this pair, both myself and Kay, they are very clear when they want to apply pressure to certain moves in currencies. They've been pretty light on that in the rally so far, but now they're stepping up again. What do you make of it all, Kay? Do you think we're at the end, or they're just giving us a warning flag?
Well, I think it's a warning flag, and it could act as a red flag on the dollar China bulls to go and really test them now. But then again, we have to, because as I said yesterday and many times before, they have like massive amounts of money to be able to counter this. So I did roughly the same. Let some of mine go, keeping a little open. We also have to keep looking in the same geographical area what's going to happen to the yen, because dollar yen and yen pairs continue to go higher, so we have to be a little on our toes here. But everything else equal, to me the first measurements is if we are going to have a close above or below PBOC's fixing. I know they intervened in the offshore market, but that's a kind of George, whether they are serious or not is if we get a close above or below, or whether the market wants to capitulate, or on the contrary continue to test them. Of what we are seeing right now, I think we are in the latter one, so we are holding above, they're fixing, and we are grinding back higher. So we're probably going to be in testing waters for a while. But again, as we said yesterday, I mean, 725s can already be some kind of a level, and got a little doubt that the dollar strength in itself can take us to fresh highs, but we will see. For the moment, I think that the approach is still be vigilant. But since we already took some off and took some profits, we are pretty okay. And now let the market do its thing.
Yeah, I think looking at the price action, 350, 400 pips looks like a small knock on the head. If they wanted to show a real strong or stronger hand, they could knock this easily down to 719, 715. So this, it does look a bit of a warning signal as opposed to anything bigger for now. But we need to see what happens if we get it back up to those highs and whether they continue to keep those fixes low. So it's going to make it interesting for the next few sessions indeed, and see what happens. And as soon as we think they're near the top, it might be time to go the other way for a while. But it's a good, that's why we like trading this pair, because when they are clear about things, you get the clear signals, when to turn, when you're going to run into trouble, and that makes it nice and easy. It's not often you get such clear signals from officials as to what they're doing with their currency, and that is very helpful for trading. This one. Keeping in China, and Premier Li says they will roll out more practical and effective measures to open up. Expects China Q2 growth to be faster than in Q1, and they're likely to achieve annual growth goal of around 5%. So talking bullishly there is Premier Li. Over in Japan, Kishida did his cabinet reshuffle, and the man who's supposedly in charge of FX decisions, the currency diplomat, Kanda, he stays in his role, and it looks like Suzuki remains as well, because he was out saying that they will respond appropriately if FX moves become excessive. Then a bit of a repeat, desirable for FX to reflect fundamentals. Lately, we have seen one-sided moves. We monitor FX with a strong sense of urgency. So no change to language from those guys there. Kay, I know you in the chat room, you're looking at the TWI for the yen at the moment. It's below levels that we saw back in September when they intervened. October.
No, we are just above, but
just above, is it?
But it's getting hot. Yeah, I mean, and that's another reason why people should really come and join us in our chat room, because we not only talk about technical setups or so, but we really try to find the exactly what's going on with currencies or other stuff, and looking at what the major players, a central bank or a ministry of finance, undoubtedly being a major player, as we've seen with the PBOC now, and as we heard already about the Ministry of Finance. So really, I mean, it's really worth joining the community, just because we have been talking about that this morning, and we are getting to very interesting levels, which not only because of the jaw burning, but which can tell us that we are really close to levels where the risk materially increases for interventions. And if we look at the yen pairs this morning, it's again going. Dollar yen is at a fresh high right now.
Yeah.
And if you look at the euro yen, it's just explosive. And getting to know exactly what people are looking at is perhaps not half the job, but it gives us like very good information about what the future may look like for a currency or for an asset.
Yeah, very much so, because we've been pointing out this difference for probably a few days now. Is that this is when this area here, this prior high up 148, was when dollar yen was up at the 150s, and then it started getting battered by intervention. So we are higher in a lot of yen pairs than we were back then when they intervened. So this shows you that this is a different trade, a different move to what we got back then. A lot of what happened in the dollar yen, let's put it on a cleaner chart. a lot of what happened in this dollar yen move up to the near 152 was in big part driven by the US side of things and what the Fed were doing. Because while this was making highs, pairs like cable, euro, dollar were making lows, and yen crosses were not getting up to these sort of highs. But now we're seeing yen crosses higher than they were back when they intervened. So this shows that it is a bigger yen problem than it was back then. And as Kay mentioned, and as we're talking about in the room, looking on a trade weighted basis, potentially that's what officials are looking at, and they're seeing that yen is all over much weaker. That may give them the ammo to intervene fairly soon. It may not just be dollar yen that triggers it. It may be some of these crosses and the yen overall that will do so. So with everything danger territory, we know, as we mentioned yesterday, probably a couple of steps from them intervening, at least from the language perspective and what they start throwing in, speculation, not moving in line with fundamentals. If we get those comments dropping, then get the tin hats on, I think. But we always have to stand for the risk that they don't do that and they just come steaming in with some intervention. If we see, pairs like this ripping another 100 pips higher today, I think, it's definitely time to get the tin hats on. But we can only sit and watch and wait and let them decide when and what they want to do. Over in Germany, the Bundesbank, they had their latest monthly report out, and they said the German economy has bottomed out and they expect slight GDP growth in Q2. This is the Bundesbank that said growth will be positive in Q1, and I think that later on the afternoon after they said that, or later in the day, we got the GDP report that came in as a negative number. So I'm not going to take too much to heart what the Bundesbank say, because they were wrong. They do say that German inflation rate is to slow in the coming months, but price pressures to remain very high. German industry continues to largely weather the decline in demand, which maybe goes against what's actually been happening in some of the German industries and some of the trade bodies who are not so bullish on things as the Bundesbank are. They also denied the report that they would need recapitalisation over bond losses. That was a story in the FT from yesterday, and forced the Bundesbank to come out and dismiss those rumours altogether. ECB's Simkus says at least one more rate hike is needed, but it's too early to say whether there will be a September hike, although we shouldn't exclude the option of a SEP hike. ECB's Kazakhs sees rate hikes past July, even if the economy softens. He says the risk of doing too little is bigger than too much. He can't say at the moment how high rates will go. The Eurozone economy is on the soft side. He's not comfortable saying now that July is the end of the rate cycle.
Guys, sorry to interrupt. I'm off for 1 minute. I'll be right back, okay?
Yep, no worries. Inflation must consistently undershoot 2% for cuts. So probably the first indication from an ECB bod on what would bring about the ECB cutting rates. So they need, according to him, they'd want inflation well under 2% for a consistent period. So it's not just inflation getting to target, but actually falling back under target. Well, actually, the ECB's official target is below but close to 2%, not on 2%. ECB's Lagarde was out at the Sintra event and taking a bit of a hawkish stance, but really hammering it home, the rhetoric, saying it's unlikely the ECB can say soon that a rate peak is reached. We are committed to reaching the inflation goal come what may. We cannot waver and we cannot declare victory yet. The second phase of the inflation process is now starting to become stronger. We need to communicate clearly that we will stay at those levels for as long as necessary. Now, hawkish sounding, but does that mean we're going to get 5 more hikes? I'm not so sure. We know we get one in July. SEP is well on the table. Inflation data is still going the right way for now. I think, as I mentioned before, we're in that part of the process where Lagarde and people like Powell need to make sure that they don't give an inch for the doves, for the market doves, to undo all the hikes that have gone on. The higher for longer message that they're implementing now is an exercise in keeping things well bid, keeping the rate hikes in the pipe working, because if the market starts to pivot prematurely, it undoes a lot of the tightening that the banks have done. They don't want to let go the margin they've got in hikes at the moment. Doesn't mean rates are going to 6% in the Eurozone. Doesn't mean they're going to be hiking for the rest of the year, although that's data dependent. It's all about keeping this message. Now, the difference is, and I've had this conversation on Twitter this morning, you know, they were wrong when they were calling about inflation being transitory, and people were starting to question whether they're going to be wrong with a higher for longer message. It doesn't matter. They can be wrong on this side of the trade, because if they don't keep rates higher for longer, it means inflation has got back to target and they can bring rates down to neutral. So this is the big difference between when inflation wasn't transitory. They can be wrong on the higher for longer message because it's a win for them if they are, because it means inflation has come back down. So don't confuse these comments, these hawkish comments, to mean that rates are going to go meaningfully higher from here. It's all down to the data, yes, but you know, I wouldn't go buying euro dollar on comments like that from Lagarde on the thought that rates are going to 6%, because that's not going to be the case right now. What do you make of her comments? She was pretty firm, wasn't she, Kay?
Yeah, she, in that sense.
Hello, I'm back. Sorry, carry on.
Nice, mate. Yeah, go on, Kay.
Yeah, in that sense, she does push the message through for quite a long time. But yeah, it's as you said, is the risk for her being there now seems to be low. So she just continues to push the message through. And also it's in reaction to what the market tries to do, and is to counter whatever those central banks may say that they will do, or keep the rates for higher for longer. The market always tries to go the other way, and it's perhaps part of the message is just to tell the markets don't mess with us right now, or don't start to reprice stuff that it should not be repriced now, or we don't like it when you do that. So that's also part of the message, I reckon. But yeah, I think in a way it does underpin the euro a bit. Of course, we are end of whatever this week, and as a matter of fact, we are seeing euro crosses being bid up as we saw overnight. Aussie was doing well with the Chinese yuan, so Euro Aussie went quite a bit lower overnight, and but we're already back to yesterday's numbers.
Yeah, and that the Aussie did get a bit of a lift.
And I think that's telling for what's happening in the euro right now. Is that it just can't stay low in a way. But I don't know. I mean, let's see what happens further in the week. It's a bit tough to trade long term when you are in a week like this, when short term flows are so important for where the market is going right now.
Yeah, exactly. Right, let's move on quickly to the Bank of England. There was a poll out from Reuters showing that many analysts expect the BOE to lift rates by 25 pips in August, and then another 25 in September. There are some banks who are looking at a 50 pip hike next month, but those might be drawn down a bit the closer we get. Market still thinking a terminal rate of around 6.25%, which I think is very punchy still. But most of the market thinking that we've got two more 25s to come, at least August and September. BOE's DINGRA, one of the non-voting members for hikes, wanted to stay unchanged at the last meeting. It says the MPC is focusing on services and core services inflation. Wages are responding to inflation with a lag. There's also a lag between falls in PPI and CPI, which she puts at 1 or 2 quarters. I think it might be a bit quicker than that, but she's probably not far off on that metric. So that's why we're keeping a close eye on the PPI, because it will be a driver of inflation with that lag. I thought the pound might have got a bit of a lift on this headline, but there seemed to be little movement. And that's UK Chancellor Hunt says he will sign a memorandum of understanding with EU on cooperation in financial services. This one had been sailing under the radar for a while, what's going on between obviously the UK and EU on financial services due to Brexit. An MOU had been on the table for quite some time. Unless I missed something, this is now popped up again, and one will be signed, which I thought might be, as I say, a bit positive for the pound, but it didn't really react on that. Coming over to the US, apparently Ford is looking at some engineering layoffs in the US and Canada. Trying to get some numbers on that to see what was coming, but couldn't find anything. They didn't give any numbers. Bloomberg got their nose into the story and headlined it that it will be in the hundreds, so maybe not huge job losses. Ford has lost about 10,000 people over the last year. They employ 173,000 globally, according to some public filings. So could be a start of maybe some industry layoffs in the automotive sector, particularly in the US. Obviously, jobs is a big focus of ours at the moment. So we look for moves like this from big companies to see if there's going to be some large-scale redundancies coming, which obviously will affect the jobs market. But if it's in the hundreds, it's not going to have caused too many waves. Yellen is planning a July trip to China, apparently. So that may yield some further comments from her and her counterpart in China. But apparently the US are still preparing some investment curbs to do with China. So it's not all fine and dandy just yet. There's been more stuff in Russia. Putin came out with a big old speech earlier, and to do with the Wagner stuff, he said that the leaders will be brought to justice. But then earlier this morning, the FSB, which is the secret police or whatever you want to call them, the KGB, ex-KGB, said that there's not going to be any further investigation and all charges have been dropped. So I'm not sure what's going on there, whether that's a bit more of a power split going on in Russia. If Putin says there's going to be investigations and justice, and the people who enforce the justice says no, they're not, you got to wonder what's going on. Apparently, Prigozhin has touched down in Belarus, but I don't think anyone's seen him as yet. So this story,
Ryan,
yeah.
Sorry to interrupt. I'll finish what you were saying. I just want to add something to this. So
yeah, the reason we need to keep an eye on this is that if there's some sort of power struggle going on in Russia, it could lead to a potential change of leadership. That's going to be impactful for markets, because are we going to get someone who's going to be more Western friendly and against the war in Ukraine, or are we going to get someone who's even more of a hardliner than Putin? So it's a risk that's bubbling under the surface around all this. So we have to keep an eye on it. Yep, go on, Stel.
I was just going to say, I read the piece yesterday. I think it was Bloomberg. I can't remember, but it talked about the whole history of Prigozhin, whatever his name is. And apparently he used to be initially Putin's caterer. Did you know that? Yeah. And
I read it too. And
they grew very close. And then he was entrusted with leading the Wagner group, which, by the way, I didn't know, obviously, when this whole thing started. Apparently, it was going to be shut down. And so this is probably like, you know, disgruntled employee going to his boss saying, nope, you're not shutting us down. I don't know what to make of it, but it's clearly this man has a lot of influence over Putin, or influence, I don't know how to say it, but he's clearly very close to him and has been for years and years. Because like we said yesterday, you know, if Putin says, oh, you're a traitor, I mean, expect to be dead within minutes or hours. And and this guy's going to be left alone. Okay, he's going to be in Belarus or wherever he's going to be. But it's interesting that this a guy who has a lot of power, apparently, and a lot of influence. But yeah, interesting, very interesting what's happening there. I don't know what to make of it. I'm far from being an expert in these things, but, you know, I read up, and it's sometimes the stuff is funny, you know, ex-caterer and now a military group. Nice CV.
Yeah, and he's a better military prowess with his troops than the regular army, which has been the whole problem with him all along. And he's what he's been moaning about is that the regular Russian military is a complete shambles, as has been proved the case in Ukraine in various battles. But anyway, something to keep an eye on. As I say, if there is the possibility of a leadership change in Russia, it could make things worse rather than better. And that's something the markets will pay attention to. I don't know if you two chaps, any other headlines that you've spotted you want to throw in before we head to the charts?
No.
No, not really. It's been relatively quiet on the geopolitical. Well, the only thing is that, just as a reminder, we still have the ECB forum ongoing, but the major meeting or session will be tomorrow, right? With Powell, Bailey, Lagarde, Ueda. So, but it's ongoing, so we can't exclude a few headlines here and there.
Yeah, I've been trying to ignore it. I've had enough of central banks the last 2 weeks without dealing with a flood of them again. But yeah, we've got to keep our ears open for those lot. Right, so what's going on in markets at the moment? Well, it is fairly quiet. Fairly tight ranges we had yesterday. Fairly tight ranges so far this morning. Euro dollar's just pinching up against an old trend line around this 109.40 area. Has been a bit of an on-off level. This trend line is a longer term trend line for me, coming in from, as you can see there, way back in 2017 through the lows in 2020. So that's what we're nestling up against at the moment. If we get above there, we're probably going to head up towards 110 initially. I'm eyeing this one this week for potential short if we get a move up above 110, maybe to 111. If it's looking like it's a fixed lead move, I'm thinking just to have a little go perhaps here at 111. If we manage to get up there, maybe as long as we're above 110, so somewhere between 110 and 111 as a little bit of a counter end of month move, if that's what I feel the driver for that one. Dollar yen, as just mentioned, we have just made a new high, so that's keeping the trend in play for now. We're getting up to these sticky levels here. You know, 145 is obviously going to be the big area that a lot of people are watching at, but we got some traffic through 144s, so that needs to be monitored as well. And then we get up to that zone, which was a big point on the way up around 145. So this is why I'm expecting it to show a bit of action if we get there again. It was, you know, pretty much the break point for the leg up to the 150s. So an important level there. And as we said, a lot of the market is penciling this as a number that officials in Japan are going to be looking at for possible intervention. Kay made a good point in the chat room. We're getting in these sort of levels in yen pairs where you know which way the trend is. So there's nothing wrong with being long yen pairs, but we're heading to potentially towards intervention risk. So, you know, you don't want to get caught on the other side. Then again, you don't want to start shorting these pairs because they can still go 200, 300, 400 pips higher before any intervention comes. So it's a difficult thing to trade at the moment. How are you looking at it, Kay, from a trading perspective? perspective? Do you still buy a dip in yen pairs, or?
Well, it's definitely, and also based on my own calculations for end of month, quarter, semi-year, whatever. And with the Nikkei moves are also based on my own calculations. This move may not be done before the end of the week, because despite what other people may say, I think yen should actually not being bought at all into the end of the week. So it's very tough to stand in front of this train, but then it's also tempting to do so because an intervention will probably put it 300-400 points lower in any of the pairs, and that's going to be in between brackets and theoretically easy money. But in the meantime, for as long as they don't intervene, it just seems to be like a runaway train, and all those yen pairs are just continuing to trade higher. Yeah, so it's a difficult one to trade if you're in cash, but there's options, and for those who can do options, there are options. I did it on the dollar yen. My dollar yen 140 expired yesterday, so nice and cool, deep in the money. And now I'm looking actually to try and find something to the other side. But well, the good thing about options is that you know what you pay away. So if you go short dollar yen at as an example at 143.80, and you have to suffer up to 145 before they come in. That's 120 point risk. If I, for instance, buy an option to the downside, it's for 2 weeks. Of course, it's going to be a lower strike, but it's only my guarantee, my maximum loss is only going to be 40 or 50 points or so. So that's why I like options as well. It's just easier to be in the trade, but to get the premium right, you need to be right at some point. But you're in at lower levels if you buy puts, of course. But then there's a way to trade it around. So no, I'd rather look at an option, because I don't want to be there sitting if let's say short euro yen at 157 and the thing flies to 160 for the end of this week, and then you're looking at 300 points loss and wondering what you have done wrong, you know?
Yeah, exactly. I think it's important for traders trading the yen at the moment. There's two things you need to be prepared for. If you're long yen pairs, you got to watch that intervention risk. You know, you could get a print that starts 150 pips lower, which is going to blow past any stop. So it may mean you get stopped at a worse price in your stop level, unless you can get guaranteed stops. If you can get guaranteed stops, it's probably worth paying the extra premium for that. But also the weekend risk. If we go into weekends with yen pairs at highs and things like that, you have to be prepared that for any intervention could come early Sunday night when Tokyo opens for their Monday. If retail platforms aren't switched on before they do that, you're facing some gap risk. So depending on how you're trading it, you need to take these things into account. You have to know the risks to yen trading right now, so that you can adjust yourself to them and make sure you don't get caught out, or if you do get caught out, you're protected as much as possible. There's nothing wrong with getting out of a trades on a Friday night and then getting back in when retail platforms open on the Sunday, if there's been nothing untoward happening. There should be no excuses for anyone getting caught out if you know what the risks are from here on out. Dollar CAD is, I'm keeping an eye on this one because I got a bit of a level at 130.80 down here. You can see it's been a bit of a historical level. It was a break point on the way up. So I'm eyeing that as a potential support point, decent support point from this move. Now we're well through 133s and 132s. Obviously, we're going to see some stuff coming in at 131, the big figure. But 130.80 is potentially a bit of a line in the sand for another leg lower. So I'm going to be eyeing that for a potential scalp at the moment because everything going on with end of whatnots this week. Could be some funky moves. I'm not going to stick a lot of money on it if I ever go, but I might try a little knife catch on that one, starting around 131s perhaps. Stick a stop just under that 130.80 level. As mentioned, back on the dollar China, just coming in. So we have had that the warning shots fired. The levels are pretty much standing up. You know, we've given a bit of a bounce now. So the levels down at 720s, I think, are going to be important now on a technical basis. If we blast through below there, we're probably going to find that we've got a top in place. I won't be so keen to buy a dip just yet or add back into my positions with all this stuff going on. I want to see what happens up here at the top. 125, as I said, is potentially now going to become a level for that one. So yeah, this might be one. I'm just going to manage what I've got rather than look to add any more on, but we shall see and play the reactions that we get from China. Also, as mentioned, Aussie dollar found a bit of support at the bottom of this zone that I had, this 66, 60s, 80s area. You know, spent a couple of days down here now from Friday through yesterday. That was the springboard for a move up on that China news. Aussie bounced, couldn't quite get much higher, so fairly dead cattish bounce, especially what it looks like now. We're just holding the top of this zone on the retest at the moment, so potentially a bit of a bottom for me here, short term or otherwise. It's going to need a break of that, obviously, to give us a kicker lower. So for now, that's becoming a bit of support area. If you want to try longs, that's your area. You don't have to throw a lot of it below 66, 40s, 50s. You're likely wrong, and we're heading back down towards the low 60s, 60s for that one. Up top, 60, 740, bit of an old level, another one of those old levels, but 68 has become the number again. On top, we had a little couple of nose pokes last week, but it's solidified once more, so that's the main topside area for that one. I've not got, well, all I've got on the books at the moment is my dollar yuan, sorry. I'm just going to be looking to see what happens over this week and if we get any moves that kick things out of sync. Euro sterling, I was thinking we might be heading for a move down to that 85 level at last, but looks like there's going to be more hard work for that one to see that, because now we're having a bit of a bounce, getting back up towards 87. Same old levels are in play up towards 86, 35s in this 45 area, then 86, 70, then getting up towards the big 87, 87, 20 area. The levels are still the levels. Again, this one needs a bit of patience because it is playing nicely with the techs, but I think there's still a bit of indecision in these moves down here as to whether it really wants to move higher or whether we're going to have a crack at the downside. But for now, at least it's looking like it's trying to break the downtrend, but it needs a move at least up above 87s, I think, to really turn the tide around for that one. So it's still 50-50 as to whether we have a move down to these 85s or whether we break higher on that one. Kay, still, you got any magic for us today?
Yeah, perhaps.
I can show stuff if you want.
Yeah, nothing... I was going to say, why not Stelios today? So
of course, yeah. Nothing new, nothing dramatically new, but yeah, I can take a look. Let me share my screeny. By the way, I've got one of those new MacBook M2. Really nice machine. Love it. Sorry, I'm not I don't have Apple shares or anything. I just love the machine.
Right. We have push still on for you now.
Plus 15-hour battery life. I mean, that's for me a winner either way you see it. Okay, so
okay, guys, get ready for our 15-hour flow show.
So what have we got in the big picture? The big picture for me remains the same. I still think, and I know it's controversial for now, I still think that the Fed will probably not hike again. And I know we're pricing, what, 70% chance of plus 70-something% chance of a hike in July. I think numbers are going to start looking worse, and inflation is going to keep going lower, and the Fed will have more excuses to pause. And frankly, what they did last time, we said it again. I'm going to say it before, one more time, just in case people haven't heard it. What they did is they said we're skipping, but we're going to be hiking twice more. That doesn't make sense to me. If you're going to be hiking twice more, hike once now, and then maybe see how it goes and then adjust. So I'm of the opinion that you should look at what they're doing and not what they're saying. And what they're doing is they didn't hike. So I think the chances of them not hiking are a lot higher than what the market's pricing. For this reason, I think that we have now reached the top in the yields, and in my opinion, is going to take a very unlikely scenario for yields for the 10-year US to go above, say, 3.94%. It's either going to take inflation turning to the upside, which is not my base case scenario, or some kind of black swan events which we cannot really anticipate. So having said that, and thinking that yields are going to be dropping, I think these lows are going to be tested, and I think we're going to break below, because globally, economic data is already looking weaker. If you look at PMIs, mainly the only thing that doesn't look weak is employment, but that also is starting to change. Initial jobless claims in the US is higher than, let's say, the past year or so, or 12 for 24 months average. And the question is, will this stick? Will this be sticky to the upside, the unemployment? I mean, if it is, then I think the Fed will have no doubt and no hesitation in pausing. So I think yields are going to be turning lower. And also another thing I've mentioned before here, I have, I speak to a lot of people. I have friends who are not traders or bankers, but they are pretty wealthy, and pretty much everybody says these are really nice yield levels to be buying bonds. Any kind, corporate bonds, government bonds, they're a lot more reasonable for the risk that you're taking. Up until a couple of years ago, you were getting, 4% yield on junk bonds, or 5%, which is ridiculous. So now the yield that you're getting is more in line with the risk you're taking. And having spent 15 years or so of basically zero yields or close to zero for something safe, having 3, 4, 5% is very, very attractive. So I think there's going to be a lot of structural demand in these in bonds going forward. Obviously, excluding any kind of major black swan events, which, as I said before, we cannot foresee. So I think 10-year US is going to be grinding lower, and as a result, initially at least, I think risk will continue to see support. Having said that, I think that we can have easily a situation where yields are dropping and equities are dropping as well, because equities are still overvalued, in my opinion, and it doesn't make sense for equities to be where they are, but they are, and we're trading. Technically, we've seen a big breakout, in the S&P, for example. 4,200 was a big breakout. 43 is another big level. As long as we're trading above 4,300 in the S&P, I think we are firmly bullish, and I don't think there's any doubt about that. Am I saying, go in and get long here? No, I don't think so. But a retest of 4,300 is probably not a bad place to be if you have a bullish view, to be taking a nice risk reward long. As with everything, position sizing, stops, very important. We don't need to repeat all that. But for me, equities remain bullish. You have obviously some outperformed, some underperformed. The Nasdaq was outperforming on the way up. I mean, look at this move here from March to the highs here. I mean, that was what, 3,000, so 30%. Yeah, that was a pretty big move. And if you look at the move from the lows here, if you take this up to here, 23.6 is around 14,000 and change. We're still not even retracing 23.6, which is, any way you look at equities, they still look bullish. And I know it doesn't make sense for them to be up here in terms of valuations, but this is what we have. So I would still say, if you try to short these strong equity markets 9 times out of 10, at least now, you're going to get burned. So you be very, very careful. The Dixie is Another one that I think is interesting. I'm going to get rid of this now. It is, let's see. It's still looking bearish for me. Actually, no, it's not bearish yet. It's going to be bearish below 100.80. But for now, look at these bounces. They are feeble, and this is the lower high. The lows are actually the same, but look, this is a kind of consolidation pattern, which theoretically should point to the downside. So I want to be a seller of dollar, a seller of the Dixie on rallies. So a seller of dollar on rallies, yes. But not here. I will definitely short if we break or when we break below here, simply as a technical event. I know it could be, you know, sometimes it turns out as a false breakdown, etc. But I think if and when we do break down below, it's going to be a relatively easy trade to start. So I'm waiting for that. For the moment, I am. You know, I'm not bullish, I'm not bearish the dollar yet. We are still consolidating sideways, but I think this the most likely scenario is we break lower. So on the euro dollar, which is the opposite of the Dixie, I would say any kind of venture into the high 106s is not a bad buy in my opinion. We'll see how it goes. Obviously, we're not close to that at the moment, but this is what I'm looking to do. The cable is, and sterling in general, I will repeat, I think it's one of the currencies that's going to be, excuse me, outperforming this year or for the next few months. And I've said this for a few weeks now, and it's been doing well. You know, this breakout here, okay, we retested, but it is looking relatively strong. I want to be a buyer of cable on sell-off. So if we get close to this 26.2, 26.3, so 100 pips below, I think this is something I'm going to give it a try. And euro pound a lot cleaner for me as long as we're below 87.2. Nothing in any way bullish about it. You know, it's still looking as bearish as it can be. Nice little consolidation here after the impulsive move. I am probably a little bit more bullish the pound against the dollar rather than the euro, but and this is going to be on central bank divergence. I think the Fed is done, and I think the UK, the Bank of England, will have to do more because inflation is higher, because employment, wage growth is rising. Last print was rising, so this all has secondary effects into inflation, and the Bank of England will have to do something more about it. I know they've been dovish for the past 15 years. But this is a situation where they really can't get away from it. You know, even if the economic data starts turning considerably lower, and it's already, PMIs are already looking relatively weak, but overall, it's not terrible. You know, it's not. We don't have the alarm bells ringing. Let's put it that way. So the Bank of England, I think, can keep going. Will they do another 50? Yeah, they could do. Especially if we get another high inflation print, yeah, why not? And so that's the reason why I like the pound. Elsewhere in FX, the yen, I have no idea what to do with it. Eventually, I want to be long yen, so short XXX JPY pairs, but where do I do that? I don't know. Look at this. I mean, this is just a very nice ascending move, which at the moment is showing no signs of abating. So I'm not touching it at the moment. Norway is something I want to be long of. So short Euro Norway, dollar Norway. I tried a couple of times in the past few months. It didn't turn out well. So, thank God that I had a small size and tight stops. So it didn't really dent my account, but they were not successful. So I'm going to try again. Maybe dollar Norway is the one I want to look at more than Euro Norway, simply because I like being short the dollar more than I like being short the euro. Yeah, I don't know where yet, and I'm going to be looking at technicals. I'm going to be looking at what Norges Bank does, because let's face it, they're the main driver of Norway recently. Even oil doesn't really manage to move the krona, where it used to be a very, very good correlation. So I'm just observing this one as well, and I know Kay is doing the same. And this is a widowmaker. You can really get burned. And I mean, look at this move here. I'm sure lots of people got absolutely smashed into this rally here. So go on.
Yeah, I think still for those who want to play it very short term, and I'll be looking at it tomorrow 4 p.m. London time, maybe giving us a bit of an opportunity for end of month reasons. And then we are expecting on Friday Norges Bank to tell us what they are going to do with their FX for the next month. So from I say tomorrow evening until Friday. Of course, we are going to have the EU CPIs in the middle of it as well. But to eliminate them, perhaps we have to look this time at dollar Norway. But I'm going to keep a close eye on this one on come tomorrow 4 p.m. London.
Okay. Well, I'm going to be looking at it as well. I'm going to be following what you do.
Yeah, but then only for a couple of days, until we know of the Norges Bank. But if they start to change, because they were not happy, right, about the Norwegian kroner over the meeting, their monetary policy meeting, they were not happy about the kroner. Kroner did react some, but then we had those pretty violent spikes over a couple of days sessions. But I think I don't know, something tomorrow around 4 p.m. London time, maybe a moment to carefully watch dollar Norway.
Yeah, and let's remember the depreciating krona means that this is inflationary for the country. So they're hiking 50, trying to tame inflation while selling krona and causing inflation. It doesn't make any sense. But so one of the two has to stop.
Yeah, I mean, they're a combination of the Japanese MOF and the Bank of Japan. MOF tries to strengthen the yen, where the Bank of Japan goes like, "No, we don't change anything to the monetary policy. Just go on, hit me."
Yeah.
Well, I hope both of you, especially Kay, are sitting down, because I'm going to show a chart after you're done still, and if Kay's not sitting down, he might fall over.
Okay. Well, I'm waiting for that. Okay. So 2 more things I want to look at. One is cryptos, which did break out of this descending trend line resistance on the back of the BlackRock ETF. Again, I'm not convinced that having another ETF or having another way for institutional money to be speculating and trading on cryptos is good for the value of cryptos. Remember the big drop in, let's go back. This drop here, December 21, or was it this one here? One of these two peaks was just after the first ETF or what is the future? I can't remember. Some kind of instrument was set up to be able to trade.
When futures first started trading.
Futures, yes.
The first spike that got.
The first spike. There you go.
Yeah.
There you go. So futures were introduced, bang. So is this good? I'm not convinced, but the market seems to like it. And they've outperformed. Remember, I was saying for a while before that crypto is going to be underperforming equities unless there's some kind of event or tape bomb. Well, we got it. Before that, they had been creeping lower in a really not bullish way at all. But this event obviously broke above. And now we're testing 31K, which is the previous high and really, really important level. And also, if you go back, this level, region around 28 to 32K was quite important. There was a lot of traffic there. So interesting levels for cryptos. I'll tell you what, if you had been long and caught this move, I definitely an area to let go of some. I mean, it for me, it would make perfect sense. Ethereum is trading worse. I mean, that's also bounced, but it's not near those highs before. I'm not trading these. I haven't traded them at all. And going back now down to metals, interesting levels here as well. We did break below that 1925, 1930 area that we're talking about, but we are trying to kind of ease back inside. It's a tricky situation. I think yields yields not rising is going to be a boost for metals, but I still think it's a 50-50 that we actually break below, go towards 1840, 1850 in gold, and 22 or sub 22 in silver. So I wouldn't be hasty to get into this if you're considering it now. I have a long in my full size long position in silver, but 10-15 cents offside now, but I want to, for the first time in ages, I'm going to add more than a full position on this because I really like it. Look, this is an area I had circled. We came in, we bounced, but it's really not convincing yet. We have to break really above 2450 for me to say, yes, this was the low and we keep looking higher now. So a long way to go. And if we do turn around and break, then we're going towards, well, 19. I don't know. It's a long drop from there. So there's a level of 20, but really the big support areas in the in 19 roughly. So I would say patience with that, and that's pretty much it. So I'll give it back to you, my friend Ryan, and you can show us the chart. I'm sitting down.
You're sitting down. Okay, sitting down. Now I hope it works. Let me try and grab the screen. Here we go. Can you see that all right?
Yeah.
Yeah. So I was talking about euro knock on the trade-off with Michael Brown yesterday, and just looking at the chart, I was looking at it thinking, talking about whether we can get up towards these highs again, whether we have another crack up there or whether, you know, we find a top. And look, hey, I found the head and shoulders for you.
Yeehaw!
Wow.
You know me, I hate head and shoulders, but I had to pick up on this one because it looks fairly clear. I mean, forget whether I'm right or wrong with my trend line across there. That was just marking across the tops, but it's looking a bit head and shoulder-ish on that one, and could finally get a move down to that 38.2 fib down there. So look at me and me head and shoulders on that one.
Welcome.
Just shows you can teach an old dog new tricks. No, I'm not going to trade it. But yeah, I thought I'll pull that one out of the hat. Back to the loonie, folks, because the data we've got this afternoon is we have Canadian CPI out today. So we know that the Bank of Canada stopped their pause and went to a hike. The market is probabilities of a 64% chance of another 25 pip hike versus the balance to keep rates unchanged. Inflation, headline inflation is expected to drop a whole 100 pips to 3.4%. Let's get that up for you now, just so you can see the expectations. So CPI expected to drop to 3.4 from 4.4%. The core, well, the BOC core is expected to come down 2 pips to 3.9% from 4.1%. And then they have a ton of other core measures. That's the BOC core, that one there. Then we have the core common, also expected to dip back. The median, the trimmed, all the core numbers expected to pull back a bit. So look out for that one if it surprises to the upside, if it beats expectations, or even if it goes higher than previous months, because that's going to feed into rate expectations. As we are data dependency trading, and I think I'm gonna coin the hashtag DDT, we get to see if the loonie is going to move around on this data significantly. We saw big moves in the euro and the PMIs on Friday. This is pretty big data for the BOC, so keep that one in mind for the loonie. As much as I'm looking at that 131, 138 area, I'm going to be careful when there's big data like this about and see what that brings. So that's for this afternoon. We do have US durable goods as well, and some house price data from the US, as well as US consumer confidence as well later on this afternoon. So some decent data points to keep an eye on. Watch out for those inflation metrics in the consumer confidence number. That's the conference board stuff, not the Michigan. So the bigger one, and as we say, new home sales there, and some other smaller regional manufacturing services indexes later. And that'll do us for today, I think. Thank you, as always, to you folks for coming to the show and supporting us here. Thanks, as always, to my colleagues Kay and Stel for their valued input. Have a great day, everybody.
Why do you always say Kay and Stel and not Stel and Kay? I'm offended.
Alphabetical, mate.
True. Thanks, Ryan. Thank you,
and
Kay.
that's how it appears on the screen as well. So, yeah. Cheers, guys.
Thanks. Bye-bye.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.